Yo, what's going on, everybody? Welcome back to my channel, and I am truly grateful for each and every one of you guys who are tuning in. I hope to bring you tremendous value. Now, in this video, I'm kind of bringing it back to some basics. A lot of people have been leaving me comments and questions talking about institutional candles, how to identify the correct candle. People are just having problems simply knowing which candle to mark up, which candle to identify. That way they can get the best possible entry. So let's dive right into my computer and let's get to work. Now, before we just dive into the market and start marking up institutional candles, we must understand one key thing, and that is that these institutional candles are actually manipulation plays inside of the market. And what we're trying to do is we're trying to identify these manipulation areas. That way we can trade with the manipulation instead of against it. All right, but to identify and have the correct institutional candle, you have to start marking up and identifying clean equal highs and equal lows, or what some people will call even support or resistance. Because what the big ballers and the people manipulating the market do is they identify these equal highs and equal lows. Once they identify them, they go ahead and take all the money above or below them. So if we're looking at the market and the market trades up, it comes to a specific price inside the market and then turns away. But then it comes back up to that area and trades away one more time. Now we have an area of resistance, okay? Or equal highs, because we have a high here and a high here at a relative equal area. But once the market comes back to this area, what retail traders are told to do is to sell it at the roof and buy it at the floor. However, we're not going to do that. We're going to sit back, be patient, and wait for the market to do its thing. Because what is really going on is there is so much money sitting above these highs. The reason why is because people are selling it when it comes to a roof and they're buying it when it comes to a floor. However, we're going to be patient and we're going to wait. We want to wait and see all this money be taken before we enter for a trade. So as the market comes back up to this specific price, the big ballers are going to buy the market. They're going to push the market all the way up to simply capture all the money that's over here. Once they capture all the money that they want, they're simply going to go ahead and turn and sell the market right back down into that consolidation zone that it was previously in. The reason why they do this is because once they take all your money to the upside, what a lot of people tend to think is, okay, they're not selling the market now, they're now buying the market. So as the market is going up, 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 they start buying, and then go ahead and sell it right back down. So not only are they taking your money from you initially selling the market, they're going to take your money once you start buying the market as well. So they're going to just straight up play with your emotions. They're going to manipulate you over and over and over again, unless you sit back, you be patient, and you wait for the whole schematic to play out. But after you simply wait for this to happen, you now can identify where your entry points are going to be. Because as this starts trading back down to the downside, your eyes should go back up to where the manipulation happened. The manipulation happened right here, which took all the money to the left. Now we're simply going to identify the last up candle before the down move. Okay, so what was the very last up candle before the down move? It's going to be this green candle right here. Now what we're going to mark up is we're going to mark up the open of that candle and also the 50% of the body of the candle. So first, the open of the candle is right down here at the bottom. So I can draw a line from there into the future. And for the 50%, I go ahead and grab my Fibonacci tool. I draw it from the open to the close, or the close to the open, however you want to draw it. The 50% is going to be in the same either way. Right here, you can see 50%. I'm going to go ahead and get my line tool, and we're going to draw a line right here into the future as well. Let's go ahead and clean this up for you guys a little bit. I'm going to delete this. Perfect. All right. So what you have here is you have entry point 1 and entry point 2. The open of the candle is entry point 1, and the 50% is going to be entry point 2. But the market is currently down over here. So we're simply going to wait for the market to come back up to this area. Once it's within this zone, it can be anywhere in this zone, wherever you want to enter, whether you want to enter at entry point 1, entry point 2, or in between, you have this whole range where you could be looking for an opportunity to sell the market, okay? So as the market slowly trades its way back up and comes within our zone, we could go ahead and enter into the market. In this scenario, we are looking for a sell opportunity. Now, where does the stop loss go? Where your stop loss will go right above either the body or the wicks of these candlesticks, right? If you had some nice long wicks and you wanted to play it safe, make sure your stop loss wouldn't get hit, I would put your stop loss above the wicks where the manipulation took place. So entering in here, stop loss above here, and your take profit areas are going to be the lows that the market created, right? So you can be take profit 1, take profit 2, and so on, take profit 3. That's how you get your take profit levels, targeting where money is sitting. There's money simply sitting below all these lows. There's money below there, money below there, money below there. So as the market comes back into this institutional candle, which is the last up candle before the down move, that's where we're going to look to play off of. So let me delete this real quick. Let's look at a chart, because we did have a pretty clean move that happened on CAD JPY on the daily time frame. And as you break it down to smaller time frames, you'll see exactly what happened. Now, what I tell newer people, because it seems like a lot of newer people get confused. When you're looking at a chart, you obviously see bodies and wicks all over the place. Now, the bodies are where you really need to be looking at, because that's where majority of the volume is being held. The wicks, not so much. We like to say the bodies is where the big ballers are trading. The wicks are where the retail people are trading. Now, as we look at this chart, we simply need to identify what? Equal highs and equal lows. But with these wicks, it's very messy at times. So what I tell people to do to make it a little bit easier for you when you're starting out is to go to the line chart. Once you go to a line chart, things will start to be a little bit more clear, because you don't have those extra long wicks. Now, breaking down this area that I am going to box up right here, looking at this whole area that we have in the chart, there is an area that sticks out to me right away, which is these relative equal highs that you see right in there. Now, looking at these equal highs, you can notice what happened right after these equal highs were created. Well, it did push away once it came back to the area, but then it immediately pushed back up to the upside. And if we go back to the candlesticks, you can see what candle created that manipulation. Well, it was this candle right here. And I'm going to get rid of all this so you guys can see exactly what happened when I play it out. But the manipulation that happened was within this candle right here. You can see it clear as day. Going back to the line chart, relative equal highs, a lot of money sitting above there. Then we had this push up. Right after we had the push up, it traded down very, very quickly. And that's what you want to see. If the market traded above, took the money, and just slowly started coming back down, then I would say wait a little bit longer. That might not be an institutional candle. We want to see a whiplash in the market. We want to see the market go up super fast and then down super fast, or vice versa. We want to see the market go down very fast and then come back up even faster. All right, so that's what we're waiting for. Now, once you see this pattern play out, there's another key thing that I want you guys to understand and take note of, right? You see this low right here? This low was broken after this push down. All right, so we had these equal highs, market traded down, it created this low, market pushed up, and then pushed right back down, and it created a lower low than the previous low. And that's key, because if the market came back down and never traded below that low, if the market came back down here and traded back up and never broke below that low, then we would sit back, we would be patient. You want to see the market move very quickly before you do anything. But you want a low in this scenario to be broken before you go ahead and mark up and identify your institutional candle. So now, where's that last up candle before the down move? It's this candlestick right here. So we could identify the open of that candle all the way to the 50%, and we can drag that into the future. I'm going to bring up my Fibonacci tool to measure this candlestick to make sure I got it right at that 50% area. Boom. We can take away the Fibonacci. I'm going to clear the background, and boom. So this is an area that we're going to be looking for to enter the market. In this scenario, we're going to be looking for sells. You could enter at take profit or entry 1, or you could enter at entry 2. Stop loss is going to go right above these wicks, which is about 40 pips. Sometimes, depending on what type of trader you are, I like to round up just in case. So I would be looking about a 50 pip stop loss, and take profit 1 would be wherever this low was created. So if I play the market for a second, all right, well, it played out. But this low that it created right here, if we go back to the line chart, this would be my take profit 1 area. All right, take profit 1, take profit 2, and take profit 3 will be down over here. All right, so those are the 3 levels I am looking at. And as you can see, what happened, the market came back up into this area. And if you did have that tight stop loss right in here with this wick, you see that it did trade slightly above. However, going back to where majority of the volume was at, it was not traded in that area. Going back to the line chart, you can see the volume stopped right in here, right inside our zone, giving us a clear entry to take that sell position. Stop loss about 50 pips. Take profit 1 is about 55 pips. So in this scenario, if you're doing just take profit 1, you're looking at a 1-to-1 ratio. But as we pull all the way out to take profit 2, we're looking at 115 pips, and take profit 3 about 150 pips to the downside. So about a 1-to-3 risk to reward ratio. I like to have at least a 1-to-2 risk to reward ratio. If you can play inside that range, then you're going to be looking pretty good. But back to the candlesticks, you guys can see we are having a lot of consolidation right now, but take profit 1 was hit with this wick when it came back down into here. Now kind of just holding it out, letting the market do its thing. But you guys can clearly see the manipulation that happened within this whole area. So go ahead, take that trade with confidence and just let it ride out. Hope you guys got tremendous value from this video. Nothing but love, and I will talk to you guys soon.